All right, welcome to our workshop titled Machine Learning Application in Financial Trading and Investment. So this is a workshop, one of in the series of AI application in finance. My name is Abubakar Sani Ali, and I will be the one who will walk you through the contents of the workshop. As a disclaimer, we want to mention that the contents of this workshop and what we are going to discuss henceforth is purely for educational purposes and not a financial advice. So for those seeking financial advice, then we will kindly suggest they go and talk to a financial advisor. For our agenda today, we're going to see an introduction. I will talk a little bit about the basics of machine learning, case studies. We will then use AI or a machine learning tool to develop a trading strategy. After we have our trading strategy ready, we would like to automate it using a trading bot so that our trades are going to be made automatically for us. And to do that, once we have a framework, we will go ahead and follow the framework to build a trading bot. And this is going to be done live. We will have an interactive Q&A at the end of this presentation so that attendees can ask questions regarding few things that maybe they might have concerns about. So once again, I welcome you to this workshop. And as I said, I am Abubakar Sani Ali. I am a PhD graduate with specialization in electrical and computer engineering. My PhD was about application of AI and machine learning in the context of telecommunications. However, I've used machine learning in different fields, which includes the financial industry. The host institution is called Asa Taura Services. It's a company registered in the United Arab Emirates, and we provide consultancy services in areas related to AI, IoT, and cybersecurity. We also provide training and workshops, as well as research and development in the area of AI, IoT, and cybersecurity. So our goal for this workshop today is to have a good understanding of machine learning and its application, especially with regards to trading and investing. Not only that, we would like to see some case studies where AI and machine learning are used in order to make successful investing and trading strategies. We will explore how we are going to build a trading bot that will use a linear regression as well as a dimensionality reduction technique, which is an unsupervised machine learning technique that we are going to have a look at in the coming slides. So I will start with a little bit of an overview. Okay. Before we move into this, I think it is important to establish that when you are trading, there are always three things involved. The first is the strategy you are using to make your trades. The second is the psychology upon which you are associated with during those trades, and the management. How do you manage your account and your capital? So for the strategies, these are the rules, the step-by-step process you follow to identify a trading opportunity and to enter a trade, as well as exit from a trade. The psychology is your emotional state when you are making these trades, and the management is how you intend to diversify your investment or how you intend to take your profit and exit a trade. And also at the same time, what is the amount of money you are willing to bet on each trade you make. So now we would like to talk about algorithmic trading, and this is the process where we use computers to execute our trades. So we have some algorithms which we will define that will follow our strategy, which we will otherwise have to run it manually. But then now we can use the computers to automate them so that they can be able to work and run automatically for us. Not only that, our objective is to make sure we execute trades at the possible prices, best possible prices, not because if we are going to depend on ourselves, sometimes we might not be available when a trading opportunity presents itself. But if we have this algorithmic trading bots that work on our behalf, they can be there 247 monitoring and trying to take on every opportunity that presents itself. But lastly, the impact of human emotions in our trading activity will be significantly reduced because these bots do not have any emotions. For that reason, they bring to us so many benefits, including efficiency and speed, consistency and discipline. They provide improved risk management. They allow us to backtest our strategy because they can go back in time, whereas we cannot go back in time. Whatever strategy we come up with, if we want to test whether it works or not, then we have to now test it in the current time and maybe the future time. But with the bots, we can use historical data to see how they will fare in time. And this provides us with immense ability that will allow us to to have, fast execution and fast process in terms of our strategy development. Lastly, the scalability they bring to the table, where you can have multiple trading bots that can be waiting and monitoring different assets for you and entering and exiting trades for you when necessary. Machine learning comes into the picture for several reasons, which we are going to see some of them during the course of this workshop. As a primer, I would like to start by giving an introduction of machine learning. One important thing to know is that machine learning is a subset of AI. So artificial intelligence comes in different shapes and forms, and one of those shapes is machine learning. Then another type of machine learning, which is one that is making so much impact currently, is the deep learning, where neural networks are the core or the engine behind these techniques. And neural networks are algorithms that were developed to mimic the human brain and how our brains function. Machine learning in general are systems that tend to learn from experience. We provide them with historical data and they try to learn about how the data is related, the pattern within the data, and try to come up with so many uh, associations and so on without having to be explicitly programmed. So we do not have to tell them that when you see this, it is this. When you see this, when this happens, this is the next thing to do. They tend to figure out that on them by themselves just from looking at the history. Some of the applications which you are familiar with include email filtering, where your email is filtered into separate folders upon receipt. This is done by an AI. You have speech recognition, where you have this AI or robot that is able to recognize human voice, translate it into written words, generate a response that corresponds to the instruction received from the voice, and also maybe, if needs be, translate its regenerated result into an audio so that you listen to the audio without having to read the response. We have so many of them like Siri, Alexa, Cortana, Google Voice, and so on. Predictive analytics. This is used mostly in the industry to predict so many things that are going to happen in the future. For example, what we're going to see in the case of trading and investing, we will see how we can predict the future price of an asset so that we can make an informed or data driven decision on or with regards to that asset. Some of the real life examples include a case study where we have Target, that retail chain in the US. So they have this marketing campaign where they look at the shopping activity and history of their customers. Based on that, they generate a personalized and customized offers and discounts for that particular customer. And one of those customers happened to be a lady who was, was a teenager at that time, and she was pregnant. So they sent her a mail which includes flyers that provide her offers for baby products and stuff like that. However, her dad was the one who happened to receive that mail. Upon the receipt of the mail, he went all the way to see the branch manager and started complaining, only for him to realize later that, yeah, truly his daughter was pregnant. So this is one application that made a lot of noise when it happened, because so many policies related to privacy and what have you were put in place after that issue. Another prominent example is the case of Obama election in 2008 and 2012, where Obama was able to mine data. So if you follow Obama on Facebook, he gets access to all the information about your friends, and looking at all the association between you and your friends, they get to know who are likely going to vote for Obama, and they get to double down by providing targeted campaigns and what have you. And that significantly improved and enhanced the chances of him winning the election. So then, if that is the case, we need to understand then, because from what I just said, we have different applications of machine learning then. So what are these applications, and when and where are we supposed to use these algorithms? Are we going to have a universal algorithm that can solve all types of AI or machine learning problems or not? So that's what we're going to see now. So when it comes to tasks, we normally categorize machine learning algorithms into three different types. We have the supervised learning, unsupervised learning, and reinforcement learning. Supervised learning approaches, these are those that kind of mimic the way a student learns from a teacher. So if you have a teacher who acts as a supervisor, hence the name supervised learning, so the teacher will be providing the student with examples and at the same time provide the student with the responses or the answers to the examples that the teacher is giving. You can consider this student-teacher relationship, for example, in the context of, let's say, an intern trader and an expert trader. So if you are, let's say, in the Wall Street, you have an expert trader and he has a mentee who is mentoring. You can be able to show him, okay, so this is a stock, let's say Amazon. Look at these features, okay, look at the volume, okay, traded in that day. Look at the RSI, look at the MACD, look at this, look at that. And when you see things like this, most likely the price is going to reach this value, this level. Okay, the price is going to increase maybe by so percentage. You can convert the percentage to the numerical value. Okay, so this is kind of supervised learning. Okay, you can say the price will reach this level, or it is gonna go up, or it is gonna fall. You know, go up or fall, or the price is going to reach this value. So if you say the price is going to reach a particular value, we call that a regression task. What you are trying to do is predict the value that is a continuous continuous element, continuous numerical figure like 10, 20, 30, 31, 40.5, and so on. However, if your prediction is basically to say it is going to go up or it is going to go down, up, down, this is a binary kind of a thingy. Okay. In this case, we are going to say this is a classification problem. In this case, it's binary. It is going to go up or it is going to go down. But if you add another one, let's say it is going to go up, go down, or it will stay sideways. So 1, 2, 3, three classes. This type of problem, any problem that comes with with 3 or more classes, we call it a multi-class classification. So this is a multi-class classification problem because our problem is in 3 different levels or more. Okay. The unsupervised learning approach, however, okay, it's like having that intern, or I would say the mentee, getting all information, let's say from the teacher or from YouTube and Google, collating all this information without any teacher who will be telling him, when you see this, this is what is going to happen. He collects all this data, all these videos and everything, sits at maybe at his own convenience in his room, try to figure out how the market works on him, by himself. So this is an unsupervised learning approach. He has the example, okay, because he got all this, maybe this charts, from all these tools out there, and he just keeps trying to figure out how things work by himself, how things associate, how things, which indicator is important, which one is not important. If I put, let's say, RSI and MACD, I am putting the same thing. They are all volume related indicators, so I can just do away with one and things will work. All these kind of things, it will try to figure it out on its own, okay, from the data. So supervised learning requires data at the same time with a label. Unsupervised requires data, but the label is not provided. For reinforcement learning, no data, no label. So this is like just throwing the trader into the market, tells him go and trade. So he goes with his money, tries to buy stocks, blow up his account. He feels the pain. Then he has to go back again into the market, maybe with a new, he got some money again, went back to the market, made a little amount of money, and he is happy. So the experience he has now will start to form his model for him. Over the years, maybe after years of trial and error, he comes to build a good model of the market, and he knows now how the market works on him, on his own, without having that data beforehand to train. So this is the reinforcement learning. So that means if you have data available, just go for either supervised learning or unsupervised learning. If the targets are available, then your problem, just go for a supervised learning approach. If you do not have the targets, okay, you only have the examples, no answers, go to unsupervised. If you have none, no data, no answer, go to reinforcement learning. Okay. So in unsupervised learning, I've talked about regression and classification for supervised. For the unsupervised, we have what we call clustering. This is where we group data according to distance. So we look at things, see that those that are similar, let's put them together. Association is trying to figure out how this and this will, connect. Is there any relationship between them? Same with the link prediction. Here we try to figure out, relationships within the data. Whereas data reduction is a little bit different. Okay. Here what it is doing is, as I said, for example, you figure out, I have MACD, let's say I have RSI, all of these are volume related indicators. I can actually live with RSI even if I do not have MACD, for example. So I will just stick with RSI and I will discard MACD. So this is called dimensionality reduction. Here we try to reduce the number of features, and that is just to avoid so much complication and confusion when I'm trying to produce my own model. Okay. So if you have a lot of things put together, then maybe coming up with the right decision might be a difficult thing. But if you have very few things to consider when making your decision, your life becomes a lot easier. And this technique of dimensionality reduction is one technique we are going to see today. Okay, so today we are going to put two things together. We're going to use a supervised learning algorithm, and at the same time we will enhance the strategy using an unsupervised learning algorithm. All right, which is a data reduction or dimensionality reduction technique. The coming week we will now start working on reinforcement learning. Machine learning has been used in trading to enhance predictive accuracy, at the same time to have the ability of processing large data sets quickly, because they can identify complex patterns and trends which are otherwise difficult for us humans to identify. And it has been used in the financial market for different purposes. For example, price prediction, as I made mention earlier, and it can also be used to build algorithmic trading strategies. Lastly, it can also be used to come up with risk management and compliance strategies. Looking at this, it adds a lot of value and benefits to the traders and investors. For example, they help with the data, they help the traders and investors to make data-driven decisions. Okay, not only that, emotions are significantly reduced when it comes to trading, and the speed upon which trades can be executed is fast. So many companies have been using AI and machine learning, including the big names in the Wall Street, such as Renaissance Technologies, BlackRock, Citadel, Charles Schwab, and JP Morgan. So the next part is for me to show you how we build a trading bot that can automate our trading strategies. So if you have any question, you can just raise up your hand in the, or you can open up your mic and ask. Otherwise, we're going to start with the framework to go into little more details with regards to that. So I assume there are no questions. I didn't see any hands raised up. Okay, so I will move on. So the framework. All right. So no question. All right. So before we go into the framework, it is important to understand the tools that we are going to use to build this trading bot. Whenever you are building anything, you require some tools to do that. And the tools we're going to use today include ChatGPT Plus, Google Colab, Python libraries, and Alpaca API. The ChatGPT Plus helps us to build custom trading strategies. So if you have your own trading strategy, let's say you've been trading for years and you have found a trading strategy that has been very profitable for you, which you want to automate to make it into a robot kind of thingy, so that you can increase your scalability, enhance and improve your risk management, as well as maybe get the advantage of 247 trading. So you can convert your strategy into executable codes. That is something you normally do, where you sit with a programmer or developer and he writes the strategy for you into code. But now we can use ChatGPT Plus. We will explain our strategy to this tool, and it will be able to generate our codes for us that we can be able to use. So when you have a code, you would like to execute this code, okay? And to do that, that's where Google Colab comes into play. It provides us with a cloud-based Python programming environment. If you have a Python code, you do not need to install a Python compiler on your system or on your local machine. You can just use the web-based programming environment like Google Colab. It's free. Not only that, it allows collaboration and sharing of code between team members, and we use it to do lots of backtesting of our strategies. It's very good for that. And because it comes with a lot of functionalities, you can run complex simulations and models. So many things are pre-installed in Google Colab. Things especially that have to do with data analysis and visualization. Python libraries, since Google Colab is a Python-based development environment, we need some libraries from Python. These libraries make our work a lot easier when programming, for example. They provide like an API to different functionalities and features that we might want to implement otherwise from scratch. So these libraries include pandas to do data analysis and manipulation, NumPy for numerical computing and operations, Matplotlib library for generating data visualizations and also making charts. Y-Finance allows you to have access to the market data. TA library, this is a technical analysis and trading indicator library. Scikit-learn provides you with access to machine learning and predictive modeling process. TensorFlow, what it does is deep learning. Okay, it provides you with deep learning. PyTorch 2 is for deep learning framework, but TensorFlow from Google engineers and PyTorch Facebook engineers. OpenAI, reinforcement learning, natural language processing, all these are built with this library. So we're going to use them in the course of this workshop. Some of them, of course, for the time being. So once we have tested our strategy and we are happy with the results, see that things are working accordingly, we would like to deploy this strategy in a real market. And that's where Alpaca comes into play. So when you have Alpaca, they are a broker, okay, in the US, New Jersey, and with their API, the API is like the bridge between your code and the brokerage account. So if you have the API, you can be able to connect your account with your code and you'll be able to execute trades effectively. So when you are trading and you are trying to build a strategy, it comes in with components that should be there in the strategy. For example, how do you spot a trading opportunity? That is what we call the signal. So how do you get the signal to buy or sell? Then when you get this signal, when do you buy? Are you buying immediately, or are you going to wait for some few minutes or seconds or hours or something to happen before you buy? If you are waiting for the price to come down so that you will maximize your profit margin, then that is called a limit order. If you are waiting for the price to start rising, let's say you are predicting a higher price, so you want to make sure the price is going to follow along the trend of your prediction, then that is a stop order. But if you are buying immediately, once you spot the opportunity, we call that market order. Risk management involves the process where you manage your account balance to avoid blowing off the account. If you have your money in your account, you do not want to put everything in one trade. We don't want to put all our eggs in one basket, right? And that's where the position sizing comes into play. We like to maybe stay within the 1 to 2% range, where you invest not more than 2% of your account balance in one particular trade. Take profit. Of course, when you enter a trade, you have this at the back of your mind that you intend to get out of this trade. So how do you get out of the trade? Of course, it's either when your prediction is right. Okay, you are predicting the asset is going to increase to a certain value. Okay, the value is going to increase. So when that level is reached, you take your profit and you sell that asset that you bought. Or, of course, you expect maybe if you are right one time, another time you will be wrong. So when you are wrong in your prediction and the price starts to drop instead of increase, what do? Do you wait till when all your money is gone, or do you just accept your little loss and get out of the trade? That's what we do with the stop loss. Okay, so normally the position sizing, the amount you are putting, let's say you have $1,000 and you are trying to put 1%, that is $10, right? So the stop loss is going to make sure that your loss is not going to go beyond that 1%, which is the $10 that you calculated within your position sizing. That way, in that trade, you are not going to lose more than the $10 you calculated or allocated for that trade. Regression analysis. So now the question is, where does machine learning come? How do we use AI or machine learning techniques in this regard? We have these three components. Where are we going to use the machine learning? So in our previous workshops and what we're going to see here, our machine learning strategy is going to help us with the signaling part. Okay, the part that is going to spot a trading opportunity and then go into the trade. So whether you are investing or you are trading, if you use a machine learning, you can be able to build a signaling part with a machine learning technique. The technique we're going to use is called regression analysis. So in regression analysis, the word regression, we are trying to talk about tools that allow us to build mathematical and statistical models that try to characterize the relationships between a dependent variable and one or more independent variables. In other words, what we are trying to say is, if I'm trying to predict the stock price, so the stock price is the dependent variable. It depends on some things. What does it depend on? It could be maybe the interest rate, the inflation rate, right? It could be maybe the volume, the current price. Maybe if you look at fundamentals, it could be based on the current, the price to earnings ratio. All those ratios could be the determinant of the current, the prediction which we're going to make of that stock price. So the way we put the relationship between these guys, okay, both the dependent and independent, is the regression analysis. And that's what we are going to see. In the case of simple linear regression analysis, what we are doing is, the word simple is talking about a dependency upon one single variable. Okay, so that means our prediction, our stock price prediction, is only going to depend on one single variable. Maybe it could be the price to earnings ratio. So if I know the price to earnings ratio of that stock, I can be able to predict that this is going to be the price given the historical relationship. Okay, for example, let's say I know if the price to earnings ratio is, let's say, 1:2, for example, the price was 200. When it was 1:4, the price was 100. Okay, so now that it is, let's say, 1:8, I can say the price is going to be 50, for example. Okay, so it's going to be 50. So the lower the PE, the lower the price. This is something I was able to model, for example. So if I know this is the relationship, I can be able to make predictions. When tomorrow I see a higher PE, I can say most likely the price is going to go high. That is to say I'm dependent on only one single variable. But the case where you have multiple variables that determine the price, there is no single variable in this world that is the sole factor that determines price of any asset. Okay, so many things come into play. You will have the inflation rate, you will have the interest rate, you will have the volume, the open, the quarterly report. If you are looking at the news also, all these are going to come into play when you are predicting. So this kind of problem is called multiple regression. You have so many independent variables that you are trying, as long as there are more than one, call this a multiple regression problem. And that's exactly what we're going to do. We are going to do the multiple regression. We are going to build a model that will use different independent variables to predict a stock price. And the relationship between two or more variables could be either linear, non-linear, or there could be no relationship. In the case of linear, we could have, you know, a linear relationship with a positive slope. That is to say, as this one increase, the other one increase. For example, if I'm looking at market price, let me say house price. So I know, okay, for a house in the same neighborhood, built at the same time with the same material, the bigger house is going to cost more. So I can say there is a linear relationship between the house size and the price of the house. Okay, but the case of non-linear, we could have, okay, the case where, of course, maybe once the size of the house starts to reach a certain number, the price tends to plateau. You know, it tends to plateau at the top. So this is a non-linear relationship. Okay, but as I said, the linear relationship could also come in the reverse case where, as the price of the house increase, or as that variable increase, the price of the house will increase. For example, let's look at crime rate. As the crime rate in that neighborhood increase, what happens? The price will reduce. But as the crime rate reduce, the price will increase. So this is a linear relationship, but inverse, an inverse linear relationship. The case of no relationship, this could happen maybe because of so many things. Okay, let's say there is an election in one country, and then how do you put that impact of relation? Let's say, okay, if we take a look at, for example, what we're going to experience in 2024, India, there is going to be an election, for example, in India, for example. Will the election in India affect the real estate price in the US? So it could be, maybe, but the probability is low. Of course, the reverse is not the case. US elections always have impact on the global economy. So, but this is just an example. Like, there could be some few things where some few things have zero or no relationship. So, sorry. So some example here, as you can see, normally our data comes in a tabular form, and this is a multiple linear regression, as I said, because we have two or more independent variables. You have the house age and then the house size in square feet. So these two will be the determinant of the market value. So the market value is the is the dependent variable, is the target. This is what we are targeting to predict. This one here, house age, square feet, we call this the features. Okay, the features or the attributes, or you call them the independent variables, because the dependent is dependent on them. So based on, if I know, like, I'm training somebody to be able to predict house prices, I can be telling him, okay, a house of so age and so size is going to be priced at a so amount. So try to understand this pattern. So I gave him lots of examples of, let's say, 50, 100 houses, all their ages made available, all their sizes made available, and their corresponding price is also provided. So this, of course, is a supervised learning approach, and what I want him to do is to try to predict the house price, so that anybody comes later, asks him, how much will you value my house? I have 33, my house is 33 years old, and it comes with so square feet. How much is going to be the value of my house? So you should be able to tell. All right. And you can have a simple mathematical relationship that you can just use to work on that. Okay. So now that we know how linear relationship and how linear regression works, how do we intend to use it in our trading strategy? So our objective here is to have a strategy where, okay, we're going to build a bot that is going to make short-term trades. So it's going to be short-term trading bot. That's my goal, short-term trading bot. Assuming I am a day trader, So I want to make sure all my trades are closed at the end of the day. Okay, I will close them at the end of the day, and I don't want to hold trades maybe longer. So all these are some of the constraints of a day trader. Okay, maybe you are using the 1 hour chart. All these are, you need to tell what is the objective, and the objective of course is depending on the type of investor or trader you are. Day traders have different objectives from scalpers. Scalpers have different objectives from swing traders, for example, and investors have different objectives from these guys, right? So that is important in the first place, to understand who you are, what is your avatar, what's your persona, and what you intend to get. All right, so now coming to the trading logic. Okay, so how do we intend to buy or sell using the linear regression? So let's say we have two options, right? We want to buy, or let me call it going long. Okay, we want to go long, or we want to sell, or let's say going short. Okay, you want to go short, you are short selling. So if we want to buy, what do we want to buy? For example, as I said, I know the price of a house, okay, and the size. Okay, I know the size, I know the price. So you come and you told me, okay, let's use a term in the investing world. Okay, let me say I know the RSI, and a technical indicator, electric signal strength index. Okay, so what happens is I know there is a relationship like this. Okay, this is the linear regression. Of course, it could be a little bit, but it is following this. This is the trend. And let's say yesterday, this was the RSI value. Okay, and the price also followed the same trend. Okay, something like this. This is the price for yesterday. Today, RSI is here. Okay, this is for today. Okay, so but the price in the market is around here. Okay, this is the price in the market. Let me change the color. This is the price in the market. This is how much people are buying. Okay, so I know like this price is below the line, below the value. Of course, this is my go-to line. This I know is the line here. Okay, this is supposed to be the price, but this is what people are buying. So since I know the difference, I can be able to enter my trade here, hoping to sell when the price reaches this line. Okay, so I can make this my TP, for example. I can say okay, this is maybe, let's say $100, this is 200. Okay, then I can put my stop loss at 50. So I'm hoping to lose 50 if I can make 100. Okay, the difference is 100. So this is how we are going to go long. So once we see this opportunity like this, where the price, the real price, is less than the predicted price based on the line, we go and buy or go long. On the other hand, if you have, let's say, the RSI like this, and this, of course, okay, the same thing with my curve like this. Okay, I know, for example, this is today's price, this is today. Then tomorrow, when the market opens tomorrow, okay, tomorrow morning, people we are buying this at this price. This is where people are buying. To use a different line. Okay, this is where different color. This is where people are buying. Okay, so I know the price is supposed to be here. Okay, because that is the RSI value. Therefore, following this line is supposed to be here. This is supposed to be the price. Okay, so let's say this is 200, and my prediction is supposed to be 150. But people are buying this stock share at what? At 200. If I go and short sell, borrow a share of this Tesla, I can be able to make 50 once the price comes back to the prediction, which is supposed to be the value based on my regression model. Okay, so with this, I will just go borrow maybe one share of Tesla, wait till sell it immediately, hold my 200 in my pocket, wait till it falls to 150. I will go buy it at 150, give it back to the broker, and I will go away with my $50. Okay, so here is, if the prediction is lower than the current price, we are going to go short. That's our plan. We are going to go short. Okay, however, if for example by the end of this time, then the next time also it is telling us the price remains at this point, then it's still a selling opportunity. I will hold, I will stay in the trade, I will not do anything. Okay, there is no point, I already bought Tesla, and by the end of the candlestick, maybe the next one is formed, this thing is still applying, then I will still hold instead of buying again. So instead of buying 2 shares, I will still hold to my own current position. The only thing is, if the next candlestick forms and I saw that now the model has changed, okay, the model has changed, it was like this before, now the model is like this. Okay, so the market has adjusted to what people are doing, therefore let me get out, let me get out. At least now it is 190. Okay, I can go out quickly with my $10 profit and be happy. Why? Because I can see the model of the market is changing. Okay, so this is one good thing that at least with the machine learning you can do. But if the model remains as we had initially, generated it and built it with this slope, then we stay in the trade with the hope of getting our $50. However, if the slope changes, starts to reverse, then it's an indication for us to get out. If it remains, we keep on holding. So this is the logic, and I will have to say this in plain English to ChatGPT so that it will give me the code. Order type. Okay, assuming I have now spotted an opportunity, how do I intend to enter the market? And what I will do is I will go with market order. So I will go in immediately once I see an opportunity. I'm not going to wait. In terms of risk management, I'm going to use the ATR, average true range, and that is because it is adaptable to the market condition. Okay, so if the market changes, the condition of the market changes, ATR normally changes, and it will now change or adjust my TP and or stop loss. Actually, my TP is going to be the predicted price. The predicted price is going to be my take profit. Okay, my stop loss could be the okay, my TP divided by my risk to reward ratio. For example, if my TP is 100, okay, then my stop loss is going to be, if I want a 2:1, then my stop loss is going to be 100 divided by 2, which is 50. Okay, this could be a good risk management. So you can say you are using linear regression to do your risk management. Okay, because it will predict the TP price for you. It will predict the TP value, because let's say you have the stock now, the current price is 200. Okay, current price is $200. The prediction from the linear regression is what? 250. So that means the TP is 50. Okay, the profit you get is 50, which means the loss you are willing to make if your risk to reward ratio is 2 is going to be 50 divided by 2, that is 25. Okay, so this could be a way, and this is I think what I'm going to use, this approach. Another approach is for you to use the ATR to allow it to be setting your TP and your SL depending on the market conditions. So if the market condition change, it will change the TP and the SL accordingly. All right, so this is what I will do for now. Okay, so Let's look at the framework. So this is our framework, which we have been using for some time. Okay, and based on this framework, we've been building so many robots. Of course, some of the robots come with all of these processes in place. Some come with only few or less of this. For example, when you do not have machine learning in the mix, you do not need to do the machine learning process. You can eliminate this process. So the machine learning process is what we have. So I will follow this framework. I will start by setting up my environment. Then I will build my strategy. I will now add the machine learning into the mix. I will test my strategy. After I tested it and I'm happy with the result, I will connect it to the market. And finally, I will automate my trades. So this is the machine learning process. I will start with data collection. Okay. I will collect the data, historical data. Then I will prepare this data for training the model. I will pick a model that is the right one. Here is linear regression. Then using the data, I will now train this chosen model. After I finish training it, I would like to see how well it is going to fare in the real market when I give it examples of houses or stocks it didn't see before. If I'm getting good results, I'm happy, I will go forward. If not, I will tune it for accuracy improvement. The second thing here is the PCA. Okay, so I told you earlier we are going to have another machine learning algorithm added into the mix, and this is called the PCA, Principal Component Analysis. So this is a dimensionality reduction technique. So I will start by giving my, let's say, when we did last time, we gave it around 6 different indicators. We gave it inflation rate, interest rate, MACD, RSI, moving averages, and I think another one, I can't remember, ATR maybe. Okay, so we give like 6 or more. However, maybe out of these 6, only few of them will be more significant. The others are just noise. They are just going to add noise or add more complication to the decision making. And that's where the PCA will come into play. It will try to figure out which ones of these examples are not relevant, and it will try to reduce its impact. Okay, and tries to put in more effort into the ones that are important. So what it does is it takes these 6. You can tell it, okay, give me some components, so it will make some mix. So this is kind of making juice. You get different apples, different fruits, and you put them together to make a juice. So you might maybe double down on apple if you like apple because you want the juice to get more appleish, or you want it to be more, orange. So you do that. So you pick the one that you actually find out to be more relevant. Maybe you just have to have a little taste of, let's say, ginger in your juice. So you add a little amount of ginger. So the PCA will do this juice mixing for us. That's one application of it. So they use it a lot in different types of problems. Okay, and as I said, it helps us to just focus on the informative features. Not everything is going to give us value. To reduce overfitting, I talked about overfitting last time, and I said this is the process where our model tends to memorize our data. Instead of it to learn the patterns in the data, it just tries to memorize the examples, and that's something we don't want. Improve computational efficiency too. We might want to, because we have reduced the number of things we are taking into consideration. Of course, the time it is going to take for the model to make prediction and also to learn or train is going to be significantly reduced. So these are some of the advantages that PCA brings to the table. However, it comes up with some issue. As I said, it is kind of like a juice mixer. It makes juice from different fruits. So you can't be sure which of the fruits is the one that is adding more relevance. And also sometimes the market changes. Therefore, we need to keep on changing the mixture of the juice, the formula of the juice, the recipe. So this is some of the considerations to keep in mind. All right, so with this, we come to the end of the bot building framework, and we are going to go and start building the bot. So I will ask is if you are interested in following along, then I will share the maybe the document in the chat. Otherwise, I can just start the part without having this. Anyways, everything is going to be provided. Okay, all of the resources and materials will be provided. The video, the code that is going to be generated, as well as the thing that is going to be generated. Okay, the prompt to generate the code is also going to be provided. So yeah, if all is okay, we can start. Okay, no question. All right, I will share my screen. Okay, let me split screen. Okay. Okay, so we have our thing here. We have our chat GPT, which is one of the tools that are indicated. We have Google Colab, and we have Alpaca. Okay, this is Alpaca. Okay, we have this yes, so we have them. Okay, so if you have Alpaca, okay, you can easily place a trade manually. You scroll down, you can see where you can place a trade. Let's say you want to buy Apple, you can just put the ticker AAPL, indicate the type of order, market. I want to buy 10 shares. I will review the order, I will confirm, and it is connected. My order is filled. Here, Apple, a few seconds ago, is added. Okay, 10 of those. Okay, so if I want to cancel, I will just come here. I will cancel. Confirmed. Cancelled. All right. That's if you want to do it manually. If you want to use your code, then you can come here, get your API keys, save them, and you can use them later on. Okay. I will show you how you will use this, but just get them ready. Save them in your notepad or in Microsoft Word. And once they are saved, you will be able to once they are saved, we will be able to use them to be connecting with our code base. Okay, so the first thing I would like to do, okay, is to tell ChatGPT or to set up the environment. That's the first step, right? So if we go back to our if you go back here, the first step is always to set up the environment, and that's what we're going to do now. Set up the environment. Basically, we are installing libraries. I will do that. Copy this is going to be provided, and these are all the libraries I need. I will run this. Here I will change maybe I will call it demo pod. 2024. Okay, it will finish everything. We'll install everything and we are happy. It's installing everything. Okay, so now let's come back to ChatGPT. I will start by telling it, yeah, all this is part of the first step to set up the environment. We need to make sure we have established connection with Alpaca. So what did I say? I said I want to build a trading bot that will trade Amazon stock, and I want to use the Alpaca API to connect to the market. I've installed all necessary library requirements. I'm using a paper trading account to test my strategies. To test the connection, start by executing a market order on Amazon. Let the trade run for 10 seconds, then cancel the order. Okay, so it is going to explain based on what I've told her some few things, and then it will generate the code for me. So all I need is to wait for the code to be generated. Then I will come here and paste it. Okay, I will copy, come here, and I will paste the code. So let's go to see our Alpaca. Okay, these are our orders. So we are going to run this code, and we hope to see our order placed of Amazon, okay, automatically from the code. Okay, I have some issues. I forgot an error occurred forbidding. Yeah, told me, ChatGPT told me to replace. If you check here, tell you make sure to replace this. I need to do that. I already have my details. As I told you, you go to Alpaca, scroll down. Here you will see your API keys. Copy them and paste them. I will have mine here for the paper trading account. I will come here and I will copy them and paste them. Okay, so I will run now. Okay, let's see. We are buying Amazon. Order submitted. Aha, here you see Amazon submitted. Order cancelled. Let's wait. There is a little latency, and that's because I'm using the free version. That's where the latency is. That's why you see, aha, order cancelled. We are happy. So this is something to take into consideration. Okay, it's very good. You can use the free version to do all your back testing, and everything. So we started the order, and so now our environment is fully set. We've installed the libraries and we have tested connection with Alpaca. Everything is working perfect. Okay, so the next thing is to build the strategy, right? So we are going to build our strategy. So I will go back here. I will copy the details of the strategy and I will paste it to ChatGPT because it takes its time to generate the code. So while it is doing that, we can read what I type. Okay. Okay, so this is what I told it. So the details of my strategy are as follows. The objective, I want to refine linear regression trading strategy by incorporating PCA for feature reduction. So I have explained what linear regression is, and I explained what PCA is, what we use it for. And the PCA is for improved model efficiency. Okay, so the logic going long, just as I explained, is going to be generated when the regression line has a positive slope and the current price is below the predicted value, suggesting undervaluation. Going short, it is going to be generated when the regression line has a negative, it's supposed to be negative slope, so I can correct this. Let's see, did it change? No, it changed this. So this could be one reason why maybe you can make something. Yeah, let's change this to negative slope and the current price is above the predicted value, indicating overvaluation. Okay, so the next thing is at the completion of each candlestick, okay, or the next candlestick, we get the latest data and we feed it into the linear regression model. You will get the prediction. So if the prediction is to go long, and currently we are not holding any position, we are going to enter into that long position we will set the TP at the predicted price by the linear regression model. So this is what we are saying is, if I see Amazon is a very good buy opportunity and the current price is 200, but my predicted price by the linear regression model is 300, I'm going to set my TP at 300 and I will enter at 200. Okay, the stop loss is going to follow my risk management rule. If the prediction is to go short, that is, and I am currently holding no position of short, so I'm not holding any position of short, I'm free. Okay, then I'm going to enter a short position. I will set my TP at the predicted price. Also, I will set my stop loss accordingly. Again, if the prediction is the same as the current position, like it predicted that it is going to reach 200 at 300, and I'm already in a trade where I have already bought, let's say, that Amazon, okay, at 200. Maybe now the price has already reached 250, but I am still holding Amazon. I'm not going to buy another Amazon share again at 250, hoping for it to go to 300. I will just hold on to the one that I already bought, which is the one at 200. Okay, so that's why I told it to maintain the current position, and you can adjust the stop loss and TP according to the risk management tools. So maybe it updated that the prediction was not 300. Now it has now reduced because things have changed. It's now 280. So I will now update my TP and then I will update the stop loss as well. Okay, so if the prediction now is opposite of the current position, so it predicted go long previously, now it is predicting go short because the price now it is predicting is going to be lower than the current price. I entered at 200, the current price is 250. Initially I was predicting it to reach 300, but now the prediction of the model is saying is 240, right, which is less than, the current price. That is, maybe I should write, okay, what I'm saying is I entered at 200. Okay, now it is 250. Initially my prediction was 300. Okay, I was hoping to go to 300. Okay, now it is 250. Then at the end of this current time, the new price is what? The new prediction now drops down to 240. Okay, so you can see now the current price, which is 250, is larger than the prediction, which is 240. For that, I will get out of the trade and go away with my $40 profit. Okay, I will go away with $40 profit. I was hoping to get to what? 300 to make $100. But since the trend or the slope is changing, it is high time for me to go out and cut my, and not even cutting losses. I've already made some good money, so I will just go out of the trade. So that's what I'm saying. So if the prediction is opposite, because 250 is more than 240 that was predicted, so it is going to tell me go short. So I can see I'm already in this position. I'm hoping to reach 300. Now it is even telling me to go short, to sell at, buy it at 250, sell at 240. I will just close my position. That's what I'm saying. This indicates trend reversal, exit the trade. Okay, so I've already explained all of this. Order type is going to be market order. We're going to make the purchase immediately once we spot the opportunity. How do I intend to manage my risk? First of all, I assume I have $10,000 as my initial capital. I'm not going to risk more than 2% of the account balance per trade. My stop loss and take profit are going to be as follows. I will set my stop loss and take profit to maintain 1 to 2 risk reward ratio. So if my prediction is saying 300 and the current price is 200, so I'm hoping to get 100, meaning I'm willing to lose up to 50. I'm not going to do more than 10 trades per day, so I set maximum of 10 trades per day, and I also set a maximum drawdown per day to 5%. I don't want it to be above 5%. So maybe once I reach 5%, okay, then I will quit and stop all trading activities. Nothing will happen again. So I told you the next step is the machine learning process, but before, which is this, of course, but before we move to that, let me know if you understand this before we move to the next step. So it tells me that everything is clear and what have you, and it summarize everything. So all I can do here is, okay, let's go to the machine learning. It is happy. Okay. Okay, so for the sake of time, what I did was to run this steps. Okay, so I gave it the next step. I told it, okay, generate the Python code to execute the machine learning process. I discussed everything for it. Okay, so which is going to be the next step, machine learning process. It gave me the code here which I used. Okay, so this part I got the data, which of course will provide me with the open, high, low, close, and the volume from Y Finance. But in order to get inflation rate and interest rate, I needed to go to the financial libraries like Funded Data Reader. So I got this to get the data. After I got this, the next thing is to do some feature engineering. Okay, this is where I can get the ATR, average range, RSI, MACD, and the likes. Okay, I did that. Then the PCA follows. Okay, it all gave me because I already explained everything, the steps of machine learning. Okay, so I told it to apply the PCA and what have you. Did that, then it will label, and then it will do the training and validation. Okay, so I got this. I did feature engineering. Now I will apply the PCA. After that, I will put everything together. I will get the labeling. Okay, so our label, which is the target, is the next price of the next time frame. So at the close of the next time frame, what is going to be the price? We are trying to predict that price. Okay, so we got this, and that is what it told me here. Labeling for regression, and then model training and validation provided me with everything. So I even printed the market data to have an idea, look at it, the open, high, low for this particular date, the close, adjusted, and everything you can see. And this is the ATR, RSI, and MACD. So here you are seeing this not a number, and that's because these are data that depend on previous, so they are time series. So they needed to get some initial information, then you average them, for example, so that you get values. That's why in the first ones here you are seeing this not a number, but in the subsequent ones you can see we have numbers. So we need to remove these parts where we do not have the numbers. So we got this as our data. We now added the target, which is the price. Okay, and as you can see, this is the price, for example. So you can see inflation rate, interest rate, all have been added. Before we do not have them. Okay, we have all of this. Then we apply PCA, and all of this, how many? 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 of them were reduced to 4 by the PCA. So 9 to 4. We have reduced almost more than half. Now that we got 4 of them, then we added inflation and interest rate. Now we have a total of 5 of them, with the first 3 being the principal components of the previous 9. So that's what we have here. The target, this is what we are presenting. Here I said not a number because the last time step is not going to, we don't know the value, right? Because we truncate our prediction to that last time. So we don't know the value. That's why you see not a number in the last one here. Okay, you can print the target if you want, and you will also see that what we got here is the correct values that are okay. For example, look at the close. The first day, okay, the first hour, it closes at 96.61. The second hour, so which is the time, okay, the next time frame, it closes at 95.981. So what we are saying is, I know the open of the current, the high and the low of the current, and I be able to predict what is going to be the close of the next time frame. That is, given open, high, low, volume of this value, ATR, this, can I be able to say, so the next price by the end of the next time frame, this Amazon stock is going to close at 95.98. So since I know the price is going to close at, let me buy now. Okay, since it is now 96, so if I go short, look at it, if I go short, I will be able to make around 70 cents. Okay, so that's the idea. Okay, so now I can also do the same for the next one. I know this, for example, these values, and I know these values. Okay, for example, I know these values as well, and I want to predict what is going to be the next value, which is 96.94. So that Since I know now it is 95, if I buy, okay, if I buy for this time frame and wait till the end of the time frame, okay, by the time it closes, I will be able to buy and make what? Almost $1. Okay, from 95.98 to 96.94. So that's the idea. So look at it, 95.98, 96.94. The first one is not there, which is this one, 96.61 is not there because we do not want to predict it. So we are saying given 3.6, this guys, go and target this. So I will train my model to be able to make this target. So this, it will take this value input and it will speak to us the next, okay, closing price of the stock. Now that I know this, I can now decide, okay, what's the current price now? Is it 155? Okay, if it is 155, if I buy or if I go short, I will be able to make some good money because 155 is greater than 154, and that's exactly what is going to happen. Okay, so I'm happy with this. I ran the training, I did everything. Okay, so I got some errors, I have to say this, but for the sake of time, I was able to go front and back with the ChatGPT, and I resolved those errors to get the final result. Okay, so after that, what is our next step? Of course, if you look at it, it is going to be the backtesting step. Okay, so we want to do backtesting. All right, so as I said, every time you have issues, you know how to do this, go back and front, back and front. Okay, so make sure you do that. All right, so to do the backtesting, I want to test this strategy. Okay, and I want to simulate it to see how it works. And I got this code, I told it, okay, awesome. Next, I want to backtest the strategy. I describe above using the best training model, okay, the model that we got from this. Okay, we want to do it and we want to see that if our initial balance is $10,000, we maintain our risk management, get all the code that will do this, okay, so that we can see what happens. And it started to give me the code. Of course, it came with so many placeholders. Okay, so I have to tell it to, I gave it the details again, and I told it to replace these placeholders. So it did that, to replace all, most of the placeholders, came with some again. Okay, I told it, okay, it gave me some considerations here. Okay, and I told it, okay, look at my this, break down the code and follow with get, so that you can be able to get everything. And at the end of the day, after all these long conversations we had, I finally got the code. Okay, I didn't write anything, I got the code and I ran it. Okay, I started the runs step by step. Okay, so I got the backtesting code, initial setup, I implemented the trading logic, I got the final evaluation. So as you can see, there were a total number of trades that were made, out of which 135 I made long trades, 134 short trades, and then there are times where I was already in the trade and I got a prediction to stay in the trade or to get out of the trade. So what those times we have around 1,400 of them. I have made a total return of 1,000%, which is around, from 10,000 now I was able to make $137,000. Okay, so this is the results I obtained during the backtesting. I was happy. So the last step, of course, is to what? The last step, as usual, is to connect everything down. Okay, connect everything to Alpaca. So I told it, okay, and next step is to do this, get me the results and what have you. So yeah, I went on and off with it. We doing all that, and I got step 4, which is this one. I got the functions. Okay, so all these are the functions. You can see them: get current price, market open, and all that. So I followed this process of that position. From that position, it provides me with the code to integrate. It gave me the code to integrate, and this is the code to integrate. Okay, so as you can see now, this code is going to run, and it will keep running and running. It is now in the sleep mode. it has checked, it is going to start working. So this is how you implement this strategy, and you can use the ChatGPT to get your codes. Once you get the codes, you will use your Colab to be able to execute that code. All right. So this is going to continue running, and it has automated our trades. It's going to be using all the features from macro features, within the current price, of course, to close the high and what have you. We're also going to use the model to make the prediction. I want to get the predicted price. This is going to be our decisions whether to go long or to go short, and we get to have our logs here. We log everything. That's all right. So if there are any questions, you can go ahead and ask while we move to finish the remaining part of the workshop for the sake of time. Okay, if there are questions, you can send your questions. Okay, you can send them in the chat, or you can open up your mic. All right. I will share everything with you. I will send the code. Not only that, I will provide all the necessary prompts. Okay, and remember, when you get errors, just keep going on and up with this. Okay, don't give up. All right, that's the main thing. Of course, if you know how to code, that shouldn't be a problem. Okay. All right. So before you go, what's the next thing after this? So as usual, I would like to say we have workshops coming on. Okay, we are done with the workshops of this week where we use machine learning, post-conventional machine learning algorithms. Next week, we're going to look at how to use deep learning as well as reinforcement learning, okay, to build trading bots. And the final week of January, we are going to use natural language processing so that we can build trading bots that can read news and decide what is the sentiment of people about a certain asset before we buy or sell. Okay, so how do you get resources? We upload our videos 1 week after the workshop, and we also have our application, which you can find it by visiting our site, asatacademy.ai. In our application, it comes with all the recordings of the sessions. You get them for free, as well as resources. Not only that, there are some premium features to enhance and streamline your learning experience. And if you need any additional assistance, okay, don't forget to book your 30 minutes free call. All right, I will send the link, okay, in the chat so that you can use it to send to book your call. So I sent it in the chat. You can check it, and you can just book your call. If you want to implement a trading strategy, you can talk to me, or if you are having issues implementing the ones we did in class in this workshop, you can also talk to me regarding that. All right, so thank you all, and if there are no questions, I would like to wish you guys a good day. Enjoy your day. Bye.